all. We're going to start our post-lunch agenda. So coming up is Discovering DeFi for Stable and Equitable Financial System. We have Hassan Bassiri, who's a portfolio manager here at Arca, as our moderator, John Clarke from Algofi, Josh Lim from Genesis Trading, Orest Byskosh from Nima Capital, and Ayesha, who's COO at LedgerPrime. Thanks.
Okay, so welcome everyone. Should I say what a month for DeFi, what a quarter for DeFi, or what a first half of May for DeFi? Obviously, this is crypto, so you never know what would happen tomorrow. But granted, the people on this panel would keep everyone very safe. That's something I can personally and professionally assure. But to get started, my name is Ayesha. I work at LedgerPrime. We're a quant hedge fund. Aside from LedgerPrime, I also teach at NYU blockchain. And it was very funny to see how I normally have a class on stablecoins. And I always say that algo stables are not a good idea. And this was literally the week of final. And I said, didn't I tell you guys so? And these are comp sci students. So obviously they ran their numbers and they checked the code and all. We have wonderful set of panelists. So Hassan, you want to give your introduction, and then from there on, we'll move on to questions.
I'm Hassan Bassiri. I'm a portfolio manager here at Arca.
I'm John, co-founder of Algofi, a DeFi protocol on Algorand.
I'm Orest Byskosh. I'm an investor at Nima Capital.
Hi, I'm Joshua Lim. I run the derivatives trading desk at Genesis, which is a prime broker for crypto.
So to get started, first question for Josh. Let's talk about derivatives markets in DeFi, right? Still a very strong and emerging market. Anything from option walls to exchanges. Where do you think we are standing, and where do you think the market is going to go?
Yeah, for sure. So I think when people think about derivatives on DeFi, they kind of broadly segment into two categories. There's sort of on-chain perps. So, you can kind of think of linear products where people deposit some collateral and take a long or short view, and you're generally either doing it against other counterparties in a kind of pooled arrangement. So you're transferring risk through some sort of pool of collateral, or you're sort of facing another counterparty through a central limit order book. So there's kind of two mechanisms and a lot of sort of variations on the matching around that. And then the other type is sort of options. And I think options, there hasn't really been a good solution for a full central limit order book on chain, just because, that type of setup is very, I guess, computationally difficult, and also just it can take a lot of resources. It can be hard to concentrate liquidity when you have so many strikes and expiries. And I think dealers are not necessarily set up to handle all that. So the way it's kind of evolved in that segment is around these sort of wealth management products called option vaults, right? So retail investors will deposit basically full collateral, like 100% collateral against like an overwrite or something like that. And there's usually a set of dealers in the market that are pricing like implied vols and things like that on these options to buy the options off retail users. So that's actually kind of evolved organically. There was a protocol called Ribbon, which was kind of a pioneer there on ETH. And since then, there's been a lot of newer entrants in the space. And it's something that I think is just indicative of like a broader trend in DeFi, which is like, the ability to sort of distribute risk in a way that might otherwise be really hard to price. So like, I'm sure we'll touch on this in in the conversation here, but if you think about a DEX and just like how to price the sort of inherent convexity in being like a static liquidity provider into that sort of like a constant product market, that's a hard problem. And so, the fact that you can kind of collect a bunch of people to throw money into something and socialize that risk in a way is something that's like new to DeFi, and definitely something that creates a lot of opportunities, right, for people who can like correctly price that risk.
Thanks. I wanted to come to you, Hassan. Something we were talking about backstage, something that I've been researching on for past like more this morning or so, the need for an algo stable coin and the need of it for DeFi. Now, response that I got from one of my team members is that if Solana becomes functioning, then we may see reiteration there. I think we're still 2 to 3 years out, but you said that you've done your research on this. So
I think right now everyone wants, well, not right now, but maybe 2 weeks ago, everyone wants an algorithmic stablecoin because it furthers our goal of decentralization and open markets and beyond the purview of, or the ability of the government to seize your assets. After this event, obviously of this week, it's definitely a few years out. The problems always come back to, what is the collateral backing the coin? Is there confidence in the collateral? And in times of stress, is it going to hold its peg? And what you're seeing right now after USTs, you're seeing things like, the near stablecoin and the Tron stablecoin. But that's working today because the collateral backing these algorithmic stablecoins is the market cap is 100 to 200 times larger than the market cap of the stablecoin. So today, I don't think after what's happened, I think it's going to be a while, and it's probably going to be some combination of Bitcoin, ETH, and some off-chain asset that you're combining to kind of hold the peg. I don't think we're near that right now, and I think it'll take some time after this week.
Right. John, I wanted to come to you. Aside from a better stable coin, what are the institutional tooling that is required on your side to be catering to institutional investors?
Sure. So, Algofi is a DeFi protocol on Algorand that has an AMM, a stable swap, and a lending market. And, a lot of our users are sort of in two buckets. We have the retail users that are happy to use wallets like MetaMask that are single sig, or Wallet Connect, or things, that are fairly easy to use. But then a lot of, of our liquidity providers that help bootstrap the protocol. So these are, individuals that are putting 5 million, in assets or more on the lending market or the AMM. They need something a little bit more secure. So what we've seen is in Algorand specifically, a lot of users, a lot of institutions are using ledger devices, and they have an in-house process for managing their private keys. They use multi-signature as well. But I think, a lot also like the offering from providers like Fireblocks, where you're getting not only the custodianship, so they'll actually handle managing those private keys for you, but they have the DeFi connectivity. So it's not just, storing crypto with a custodian. You can actually deploy these in a fairly, user-friendly way. So we've seen a lot of the larger liquidity providers, asking for that. And we hear now that I think Fireblocks is coming live with a lot of chains, including Algorand in June. So that's an opportunity for larger providers to take advantage of the yields and trading opportunities that presents itself in smaller ecosystems like Algorand.
Nice. Do you want to add anything to that, Orest? What do you see? What do you see where? So given the recent market volatility and given the recent news, where do you think the institutional investor would be comfortable in?
There's a lack of products that allow for like auto hedging, for instance, in that like investors will take on a position in DeFi, and then it's very difficult to hedge in DeFi without a centralized exchange. So having tooling that kind of pairs the two would be useful as well. And I think like solutions like Fireblocks are good, but there's kind of a lag time into how quickly they're able to adapt on different chains. Like we saw, they just brought on UST and Terra like several weeks before all the mishaps of the past couple of weeks. And that's like a critical error. I think a lot of these institutional custodians, that they're not keeping up with the pace of the development of the market. I think that's something that is definitely necessary for institutions, and hopefully we'll see some new products come soon.
One thing I would add to what Orest said is in terms of like an algorithmic stablecoin, and I know Josh knows a little bit about this, but there's a protocol out there on Solana which is called like UDXO or UXDO. UXD, yeah. And it's essentially it's a tokenized position where it's a stable coin, but you're short the collateral that is backing the coin. And it's a tokenized position. So theoretically, you are hedged because if the collateral crashes, your short position makes money. And if the collateral doesn't crash, you're just in the stable coin. And I don't know how UXD performed during the recent volatility we had. It's not a huge market cap, but something like that where you have a natural hedge in the instrument itself is probably what people are gonna be going after, like a tokenized hedge, which represents a long and a short position.
So speaking of what people are going after, something that we've seen with our investors, in recent months is, the yield offerings, right? Like, because, at our fund, certain percentage was to DeFi. And obviously yield has been a huge part of DeFi. So where do you think the market is going to go going forward? What do you think? Like, would that change the cross-chain solutions? Where do you think we're headed? Like, if you were to predict with a ball?
Yeah, generally the best yield opportunities are not on ETH, given the gas fees and the maturity of those protocols relative to how many emissions they're spitting off. Now I do think cross-chain is the best way to go. But of course, the further out, the higher yields generally come with higher risk, as we've seen. And I think cross-chain is where it's at right now in terms of the higher risk-adjusted yields using things like Stargate and things of that nature. And if you, even on EVM chains, like things like Cello or, Phantom, I think after what the market's been through this past week, those right tail protocols, even though there's probably some more opportunities there, it's probably not worth the risk that you're seeing. But yeah, it's definitely cross-chain for me right now is where the opportunities are at.
Josh, what do you think on this?
Yeah, I think I talked to Hassan a lot about kind of yield opportunities because that's his specialty. But I remember we had a conversation kind of before everything went down with UST around how the market was pricing like hurdle rates on yield farming just generally, right? And I think what was happening in crypto before this whole thing went down was basically there were like two worlds out there, right? There was sort of like a USDC kind of USD yield world in crypto, which is persistently the yield on dollars in crypto has always been above like the yield on dollars in traditional markets, just because there's always been like a demand for leverage and people need to borrow for capital efficiency purposes and things like that. So that was maybe in the kind of like 6 to 8% range. And then there was this sort of UST world, which was still, around like 20% per annum because of anchor yields. And that was like obviously a disparity that couldn't be sustained long-term. And, I think a lot of people sort of assumed that there was enough sort of external backing from people outside of exogenously to Terra, whether it was from like the venture investors that were supporting the project or otherwise, that would just help kind of sustain or sort of delever it and sort of normalize the yields over time and bring it back to kind of where normal dollar rates were. But that's a hard problem, and you can kind of see like in any sort of large enough economy, it's very hard to control where rates are. Like just ask the Fed. So that was like a big assumption that I think we kind of saw how it didn't really play out the way the market wanted it to. Like right now, I think what we saw kind of post the Terra blow up was basically people were scrambling, right, to find like other ways to generate yield. And I think people's expected returns on like yield strategies are now necessarily much higher, right? Because they're kind of dealing with processing like the risk now inherent in like DeFi yield farming. So I think where it kind of went was where we saw a lot of interest was around sort of selling optionality. So basically selling vol, which you're actually then generating yield like exogenously as well, right? Just by sort of providing liquidity in the market around volatility, around large moves. So that we saw very quickly when vols, went on Bitcoin, went from something like 70 to like 110 or whatever. That immediately got crushed down. Like we saw a lot of basically people selling like 1 month options to sort of capture that move. And I think partially is, over the last 6 to 12 months, there's just been a lot of capital coming into the space, specifically around the sort of vol trading strategies in crypto. And that whole options market has really blown up in a very big way. You could just see it in derivative volumes. There's maybe $1 billion to $2 billion of notional traded per day. A lot of in the front end options. So that's going to keep growing for sure. That might be kind of where a lot of the institutional money flows into to sort of start capturing these higher yields in crypto.
So speaking of that, do you think you could warm up the institutional side again to more on the DeFi option side, or you think we're kind of staying a bit away for now?
I think right now the DeFi options are very much like a retail phenomenon. It's mostly just people, probably high net worth people and some project treasuries and things like that, who are sitting on native tokens and deploying it into these vaults. We've seen some efforts from larger institutional players to launch their own protocols that are more permissioned or KYC'd. So that could be the next kind of direction that it goes. But I think there's a general kind of chilling right now in the whole space of people kind of wanting to participate in this.
So, I don't know. Are we in a bear market yet? Are we? Yeah. Okay. So bear market, and there's nothing wrong about it, by the way. I've been in a bear market. It was 2018, and let me tell you something. All of the best projects that you see now were building back then, and at a very low valuation. Founders were head down. They didn't have private jets. They were actually building, and that's why we've seen the first iteration in 2020 and 2021. So that brings us the investment opportunity, which we're very excited about. Each one of you, what are your thoughts? Where do you think the fact that we've seen a bear market before, we've seen some functioning L1s, we've seen DeFi, and I'll get to NFTs in a bit. Where do you think the investment opportunities will grow in months to come?
I think cross-chain is going to be big if we can get a solution, and it's hard because they're all chains that run on different codes with different coding language. But I actually think cross-chain will help. It's not going to fragment liquidity. If you can find a good solution, it's actually going to help liquidity. And when we do find a good solution that works, I know IBC was working on this, but it'll take us some time. I think it's really going to make capital more efficient, and the capital is going to go where the best risk-adjusted opportunities and yields are. Right now, if I want to move from Terra to ETH, it's 5 minutes. In times of stress, it could be 20 minutes, and that's just not going to get it done. But as these cross-chain solutions improve, and the way you can measure it is by looking at Stargate and seeing how much value is being transferred a day and where it's being transferred and how many tokens are being transferred. But as that improves, I think that's going to really open up some great opportunities for not just yield farmers, but bigger trades, bigger DEX trades, and things like that.
What do you think, John?
Yeah, I think cross-chain, there's definitely opportunity there. There's a number of decent solutions today like Synapse, Stargate, Swim protocol. I think another thing that it's a little bit quieter of an issue, but I think MEV is a major problem that on-chain traders face because you have all the problems that you do in the HFT world. Plus there's the gas model that traders can basically tune in order to front run your trades on Uniswap and various other AMMs like 1inch. So I think there's going to be a lot of value in people that solve the problem of trading with minimal market impact and trading with privatized data. So I think RFQ, OTC, dark pools, they seem a little bit, like high finance today. But I think as more value is being exchanged on chain, we'll see protocols like that built out because we have it in the TradFi world, and it makes a lot of sense to have on chain, where the activities are potentially even more malicious against people trading. So I'm really excited about protocols like Hashflow. This is a cross-chain OTC provider where when you submit a trade there, you'll actually get filled by a market maker. So you're not exposing yourself to getting front run on an AMM. And I think those will be integrated with multiple chains, so you can trade ETH and get settled on Avalanche with the native token there, and more privacy around this. So when you submit your trade, it would be kind of nice if perhaps only the person that fills your order and maybe the second best bid sees that, instead of the entire market, which is the status today.
I guess like in terms of like whenever there's a bear market, there's always incredible buying opportunities, specifically for companies that are, because I feel like the past few months to arguably 18 months, we've seen primarily forks and clones of products, like a new bridge or a new farm. Everything's effectively been the same thing with a different wrap. So I think seeing new innovation in the market is key right now. In terms of where that'll come, like I think 1inch and Matcha were great innovations in terms of aggregation of trades, better efficiency overall in the markets. I believe there's an opportunity to do that cross chain across multiple venues to split an order across many chains. For in the case of like when someone's pulling out of UST, instead of having to bridge to many different places, if you can execute one order and say wait 5 to 10 minutes, but have that execute more efficiently across many different chains, I think that'll be a key solution in the market. Otherwise, like in terms of investing in new products, we've already seen like in the past couple of weeks, and you might also do early stage venture, where we've seen products like options markets for stablecoin pegs, or instead of the insurance models that we've seen either fill up in capacity or have governance modules where people can vote to not pay out. If you can just buy and sell options to one another on whether an asset will hold peg or not. So I'm very excited for like the innovations to come in the next few years.
Yeah, I think you guys all touched on kind of a topic which I think is going to be key for DeFi in the next like year or two, which is basically like the unbundling or kind of like the disaggregation of different components of a DeFi protocol. So like if you think about like a Uniswap or something, there's sort of like a couple of pieces, right? There's like the front end, the UX of someone interacting with the protocol as a retail user. There's like the sort of like matching engine piece, right? Sort of matching like a buyer and seller and what's the algorithm behind that. There's the sort of like liquidity, where does that come from? It comes from other retail users who are willing to stake capital there. And then there's the sort of like settlement mechanism, right? Which happens on chain through some sort of smart contract. Like all those things are sort of being separated out, and you can see that. I think John mentioned hash flow. That's basically you're pulling out, what's effectively like the pricing mechanism, letting dealers sort of set prices for large blocks, and then you're also turning it into more of like a settlement mechanism, like an on-chain sort of atomic settlement between two counterparties. And those are like those two features are particularly very important for like institutional market participants, because you want one obvious problem with DeFi is you don't always know who you're facing on the other side, and you need to have that KYC element to be able to operate and stay compliant. So things like hash flow are sort of allowing that in a way. There's also even things like permission lending pools where you can there's somebody who's pricing credit risk, and there's identity associated with borrowers and lenders, and you get better pricing because you understand like the nature of the counterparty that you're facing, and you also have some KYC around it. So it's probably a counterparty that you've interacted with off chain, but you're just moving it for sort of on chain settlement through this protocol. Like Maple is a good example of that. So I think that's the general trend, is like people are going to sort of pick out the features of the products that they think are important to them as a user. And for the institutional users, it's probably going to be around sort of KYC and identity.
So before I move on to fully NFTs, one thing you have to give the space for is creativity. Like even on the worst day, the founders will come up with a very creative way to incentivize the users or the investors. And one thing that we've started seeing in 2 of our portfolio projects last week alone was NFT airdrops for users. Thoughts? I mean, if you've seen it around, what do you guys think? I mean, I don't have a regulatory opinion on it, but I was like, that's creative.
Someone else take this one.
Feel please.
Yeah, I mean, we some people in our community, like we have a large Discord, Twitter following. They've created NFTs, and we've done like partnerships with them. That's been great to build like a community, because a lot of DeFi, early DeFi protocols, it's not just finance, it's also community. There's definitely a social aspect to it. There's a lot, there's I think for certain people, DeFi actually serves like a very strong utility, but for a lot of other participants, there's no obvious utility. It's more speculating on like the future of the world, which, maybe we'll live in a fully decentralized world at some point. So I think NFTs are a nice way for, retail to get involved. There's also like a sort of investor speculation aspect. I'm not so big on NFTs personally, but I'd like to hear more from the panelists here, what they think.
Yeah, so we've been investing in a lot of NFT infrastructure recently. Like we invested in Pleaser DAO, which I would argue is kind of on the cutting edge of new NFT use cases. One example of like a novel case that I've seen recently is the Bong Bear NFTs, where it's a new layer one that's yet to launch, and holding on to the NFT is kind of your ticket to an airdrop of the token, like first rights to any of the tokens in the layer one. And that's something where those have accrued immense value because layer ones tend to be priced 500 million to $1 billion at launch. And there's only 100 of the NFTs. So I think like new use cases of launching a layer one with an NFT or fractionalizing NFTs, allowing NFTs to represent different vehicles of ownership over just artwork are incredibly fascinating.
But I mean, like right there, I'm a big NFT guy too. I love them. But I think one thing I wanted to highlight with what Orest said is there's value to that. There's monetary value to that NFT. And that's why the people are there to trade it, is because the thing is worth something. I think a lot of what we're seeing right now at this stage is just you're getting an NFT that is probably not worth much. And I don't know how that really differs from just giving out like reward tokens that are also going to go down to zero. You know what I mean? So it really comes down to like how much value does this thing have? And obviously value is subjective and changes every second. So right now I like the Bong Bear thing is amazing. Like that NFT is probably worth like $250,000 and people were buying it for like $10. Yeah, because it's all speculation on what the layer one is worth. And you're going to get 10% of the layer one. So 10% of $1 billion is, $100 million. And that's split between 250 people. So it's, if it's worth $1 billion, if the layer one is worth $1 billion, so it's still like scratching the itch of speculation and gamifying it, which I think is cool.
So while I have you here, something, so speaking of NFTs, right? We have to credit, Paris Hilton and, Jimmy Fallon buying the apes and just hyping the extra additional market. We've started seeing, but there's no liquidity around, NFTs, right? Aside from blue chip, but we started seeing projects, something that we've invested in where you can earn, excuse me, where you can earn yields against your NFT, or you can trade the derivatives of your NFT. We've also started seeing a slight move of the capital from DeFi to NFTs. Do you think that thing it's going to continue? Do you think the next cycle is dependent on NFTs or derivatives of NFTs?
Josh, you want to take this one?
Yeah, so like one of the things that we've done that's kind of interesting is we've allowed people to post like NFTs in part of a broader portfolio of maybe more liquid assets as collateral against loans on crypto. So it's a pretty small, very almost negligible portion of our lending book, but it's one of these things where they clearly do have value, and like usually this is in the context of those collateral assets having some backstop bid somewhere else we have people who are willing to buy them off us and basically write options on them to us. So like that's something that that's one way of kind of transforming the liquidity on these NFTs and sort of extracting some value from them, or sort of generating usable capital off those holdings. And I think we'll see a lot more of that. I think that also kind of spurs on the use case of these derivatives, right? Like people have these holdings that they generally want to hold long term, but may want to sort of like hedge in the short term. And so there's, I think there's a lot of research right now around sort of like price prediction and sort of modeling of NFTs, especially within like a broad, collection of them. How do you price any single one? And also just like how to construct like a stable index on NFTs that's better than just like maybe a floor price, which can be pretty volatile.
Orest, what do you think? I mean, you're an investor in Pleaser DAO, and they do have a great art collection.
Right. I mean, I think the age of like the NFT flips is more or less over. Like I remember like further back in the cycle when everyone was buying rocks. It's kind of like what is like the exciting thing to buy of the week. And that's when to John's comment earlier about MEV, like many people were just sniping new listings and purchasing them and immediately flipping them. And it was what would be exciting on Twitter in order to get pumped. So in our book, like we don't hold that many NFTs, to be honest. Like we don't think there's much inherent value unless it's some real novel use case. I think cases where it's like a standard collection of 10,000 is not going to work anymore. It needs to be something where it's innovating on the model, whether that be a project that is an artist like putting out art every single day, like people for many years, or some type of financial derivative that is represented by an NFT. I think it needs to be something innovative.
And I think in DeFi and what yield funds are doing, I mean, we don't do this, but you can actually lend. It's a weird phenomenon. Like people with Bored Apes or Mutant Apes or Azukis, they are still willing to put up collateral in the form of that to borrow ETH to go buy more. And so you're getting, if you're willing to lend at, 33% loan to value, and they're putting up 66% of it, and you can lend them the rest, you're making 40% on ETH to lend them that. And it's something, I mean, you have to be comfortable as a lender, you have to be comfortable doing it. Are you going to be willing to hold this Bored Ape or this Mutant Ape if it gets put to you, or if there's a default? So it does really only work with the quote unquote blue chips. And what we define as a blue chip is like what Josh alluded to. It has to do a lot with the pricing, the volume of sales, the number of holders, how long it's been around, how, what can you do with it? Other projects called like JPEG, you can actually mint a stable coin against your NFT, and it'll trade at a floor value. And that's actually pretty cool too. It's just all ways to unlock the capital efficiency of this asset that does not trade much. So there's a lot of cool stuff happening with the intersection of DeFi and NFTs.
John, would you like to add something, or Orest, you were going to say?
Yes, I mean, so Hassan, a question for you is like, what do you think is the actual backstop of the floor price in terms of like if you're borrowing against Suzuki's and then the ETH gets their loan gets liquidated and you're left with NFT? Like how can you measure how much demand is there to prop up the floors on these things?
Yeah, I mean, that's a great question. I think the floor price is bullshit, to be honest. I think if you had to force, I mean, but that's in our space, most of the prices that you see on the screens, depending on market conditions, are also not fair value, right? If you have to sell something and you have to sell it in mass, it's not going to be mid-market, right? With NFTs in particular, that's probably 50% haircut off the floor in general, in my opinion. But I mean, it obviously depends. Bored Apes last month before the ape land sale, no problem, floor. Now, tough question. Right. So
How much are the lands selling for? Just out of curiosity.
Mihal, do you know what the land's selling for? We're co-investors in this land. Down bad, down horrendous.
Interesting. John, do you want to add something to that?
I don't have too much to offer. NFTs to me today sound, or rather they look a lot like how very wealthy people borrow against their artwork in the real world. I think it's a lot more liquid and a lot more commoditized now because there are very few people that own like, $100 million painting. So I think it's made that a bit more accessible, but it doesn't really look like anything like that. Like I am interested in the future use cases of NFTs, but today it's mostly like artwork and people speculating on like what the whales are going to buy. And I guess it is a real asset as well. Like art can only sell off so much in the bear market because eventually the marginal rich person will buy it for a certain price. So you're going to see that with NFTs as well, which is kind of a nice property. It has a slight inflation hedge, I guess.
So before I move on to Q&A, I wanted to give like each one of you like last closing thought. The future of DeFi, or How do you think markets would readjust, or where do you think the current sentiment is? From each of one of yours perspective, where do you think we're bound to be like next 6 months?
I mean, I think obviously, given the events of this past week, I think you're going to continue to see yield compression and like a flight to safety. So, ironically, I think people at prime brokers like Genesis and Josh will be even more important in like setting the market rate for stablecoins because they basically set the market right now, right? So, after events like this, it just takes some time to kind of. I think it'll be 2-3 months before we see how the chips really fall, where the borrowers are at, what collateral had to be liquidated to pay off the debt the borrowers had that had exposure to UST, things like this. But I do think that just given the market, given the macro conditions, given the S&P correlation, and given what happened, I think the yields will come down and Genesis will have some more pricing power on your stable coins.
Yay for Genesis.
Yeah,
Yay for Genesis. What Genesis, please, John, go ahead.
Okay.
No.
Oh, I think from a builder's perspective, the bear market, I'm sure you've heard this before, it sounds cliche. It's actually kind of good because it does get rid of a lot of the needless competition that there are a lot of talented people that have entered DeFi in the last 6 months and they're going to leave now because they're scared. They want to go back to their jobs. This was nice, but it wasn't for them. It's kind of good for the builders that are going to stay, like our team. So that's good on the one hand. On the other, the yield compression is good for early projects because it's very difficult for early projects to generate 20%. Like imagine if you had to compete with people that can offer you this. So now that the risk-free rate is likely much lower, I think we'll begin to see more healthy competition. Whereas, Frank, the Anchor, set more than 70% of the token was just in the lending protocol, earning that 20%. So there won't be as much of a fight where we would have to go to the foundation and say, hey, we need algos to incentivize users. We need to meet at least 20%. Now it becomes a little bit easier. So I think it's generally good for builders, and hopefully there's, LP liquidity that is, going to be using the protocols.
That's a great point.
Orest?
Yeah, I mean, I think to your question, in the next 6 months, I do believe there will be more Fed rate hikes and that we are going to go into a recession over the longer term. So I think it's an incredible time to be buying distressed assets that continue to fall over the next couple of months. I do think there will be yield compression, but I'm hopeful in the sense that as long as there's continued innovation, there'll be continuous opportunities for yield or things akin to it. So I'm really just excited to see what projects weather the storm and invest in the ones that stand.
Josh, while you're pricing.
Yeah, no, I don't think, I think we'll see like people, there's a flight to safety, like others have said. I think there's going to be people sort of reassessing like their exposures across the entire space. Like one thing that sort of happened, right, in the last year and a half is like everything has become good collateral in some sense. Like people would take these crypto assets, which are highly volatile, like post them as collateral into other protocols, wrap them, use those wrap tokens as more collateral. And there's sort of this like layering effect. And, I think people are sort of mispricing like the risk associated with that because it's not instantaneous. Like you can't just unwrap everything and unravel the whole stack of leverage in one go. There's people have these sort of, there's like unknowable things around, network latency and things like that in the times that you most need it. So I think what that means is there's going to be a migration back to sort of more centralized services and service providers, which does include my firm, but also like exchanges and things like that, centralized exchanges. And not enough people kind of talk about this, but like centralized exchanges are perfectly good bridges too. Like they also operate pretty well as a way to hop chains. The other thing that I would say is, I think the big theme of the next 12 months is still going to be sort of the ETH merge, right? So I think people need to start getting used to sort of like benchmarking expected returns on whatever thing they're investing in relative to what they think ETH will perform into the merge. So like if you think ETH is going to go to 10K, right, that's a 5x return. Like whatever you put money into now, if it's like a seed stage thing, you have to at least beat that performance. So everyone has different expectations around that and where ETH will go to, but that's what people need to put in their heads. Like, you got to beat ETH.
Josh, like when do you think we'll see an on-chain yield curve for like a futures curve for stablecoins?
On-chain yield curve. I mean,
Like a forward curve, like
the forward curve,
yeah.
right? Yeah, I mean, it's sort of like there's observable sources for that type of stuff now, right? Like if you just look at the Bitcoin sort of like the centralized exchanges for Bitcoin futures, like that sort of implies some interest rate on dollars for crypto. So I think, yeah, I don't. There was already sort of a market in the OTC space, I guess. Like we underwrite a lot of sort of derivatives on stable coins, especially for people who are hedging. So that kind of creates like a forward curve for a lot of stables. And we don't really have an incentive to make that super transparent, to be completely honest. But I mean, you can figure out like where it is, right? You just, it's very fragmented because you have to go through like a bunch of different DeFi protocols and figure out like where to deploy, like, and then weight kind of across all the different sources of yield in the space. But you can kind of do that. I guess there will be at some point, but then you're taking even more risk, like facing that protocol.
So we have like 5 minutes. If any questions from the audience, just raise your hand and the mic will come to you.
Hello? Yeah. Do you think it's possible to have algorithmic stablecoin ever, or there always have to be some central party holding the collateral, and therefore it's never truly decentralized?
I really believe in the space. I really do. No, I'm serious. Like I really do. And like if you're trying to have these massive technological disruptions with new financial technology and in this world we're living in, I do think one day someone will figure it out. Is that anytime in the next 2-3 years? Absolutely not. But one thing we alluded to was, this UXD protocol where the stable coin is algorithmic because it's backed by Solana, but it also represents a short position in Solana. I think that is, and if you can trade it on chain and you should be able to move it around if Sol ever works. But like, I do think someone will figure it out. Yeah. And I have to, by sitting up here, like I have to believe that it's going to change.
We also saw like stable coins get tested, like LUSD and FEI at the same time that UST was losing peg, and those withstood the test. So I think there are like small ones that are starting to grow, and even more ones like on the tail end that are developing still. So I definitely think the market will have an algo stable coin eventually to replace UST's place.
I think that it's hard to create a stable mechanism around it unless you have like some like the thing is, in an algo stablecoin, there's like the Luna piece, which is the sort of like volatility absorbing token, and then there's like the stablecoin, right? So there has to be some exogenous demand for that volatility absorbing token. So unless there's like a real use case for it, and there's like maybe transactional demand for it or something where there's like an ultimate bid or backstop for that token, it's hard to kind of construct a stable algorithmic stablecoin.
Anyone else? Okay. Well, thank you so much. Oh, sorry. Okay.
Thank you so much. Does the interconnectedness of DeFi worry you? As we saw last week, right? It's not just one stablecoin that goes down. We have Maker that has a close tie to USDC. If we have NFTs that are a collateral to something going forward. So do you worry about the house of card effects in DeFi and crypto?
Yeah, I think, there's definitely, like in the real economy, we see a lot of levering of positions on top of each other to generate additional yield. This is something that we see in the traditional economy. So it's definitely something to be mindful of, and it's measurable. There's a lot of data on this. I think that'll continue to grow as more DeFi products are built. I just think it's something that, like in the real economy, needs to be managed, and there needs to be like education around that. And beyond that, I'm not sure, because there's no Fed on-chain Fed. That's not something that can be handled by monetary policy. But perhaps someone create an L1 that has like an on-chain monetary policy.
I'll say something. Like, I think the introduction of on-chain visibility of stability or liquidity mechanisms is inherently unstable, because like, for instance, take Curve, right? Like, Curve is basically designed so that you can see how much liquidity is available for you to exit if you need to exit a position. And that creates inherent instability, just because you can kind of measure like how much the urgency with which you need to get out of something. And it's usually the liquidity is not going to be there when you need it the most. So it's a little different than like a central limit order book in traditional markets, where you don't really know. It's, these bids and offers are flickering in and out, and like people might have additional demand beyond what you see on the order book anyway. And you can never really know that as a market participant. Whereas like in DeFi, I think it creates these things where you can sort of have a false sense of urgency because you can see how much liquidity is actually there.
Well, thank you so much. We're around. The panelists are around, so please, find them if any other additional questions. But thank you so much for the insight, and thanks the Arca team for organizing this.